The standard forward-looking statement, it's going to refer to both Altius Minerals and Altius Renewable Royalties, since I'll be talking about both of them. So let's start with Altius Minerals Corporation. Often in these conferences, there's a string of large, very successful precious metal royalty companies ahead of me: Franco-Nevada, Wheaton, Sandstorm, Osisko, etc. It's great to be one of just a couple of royalty companies, I believe, presenting in this conference. And our big difference is we're diversified, so non-precious metals. We're a 20-year-old company, a little over 20 years. We IPO'd in 97. We've still got the 41.5 million shares issued and outstanding, never been a rollback. The capital structure you can see as an investment, yeah, we market cap right now, little more than what's on the slide, be around 770 million Canadian. There is a dividend yield, it's about 1%. The debt is between term and revolver, and the term comes due in 2023. The cash and public equity holdings, that cash is about 19 million at the end of March. That is on the Altius Minerals balance sheet. For those of you who follow the actual cash on the balance sheet end of March, had another $92 million in there, and that's all the ARR cash because we consolidate that in our reporting as a 59% owner. There's a few other things on this slide. I guess one thing to show you is just what the trajectory has been in the revenue for the company. So a lot of companies do show what their revenue growth record looks like. Ours is pretty good, as you can see, over the last 7 years. But what's more important is we're showing it here on a per share basis. So we haven't used equity to basically fund new acquisitions, drive up revenue, but also drive up the share count. We have been both a dividend payer, as you can see, since when we started in 2016. We've also had a normal course issuer bid that's been running and that we end up using every year. So together, the dividends and the NCIB go into that return of capital. And the junior equity portfolio, we're going to get into the project generation segment, what we do there. But essentially, we got about 20 positions in juniors, and that business is run to be self-funding. So the business itself has to pay for its yearly burn rate through sales of equity. And the last few years have been real monetization years as the sector got going, especially in junior precious metals. We were able to monetize 17 million in 2019. We're around 7 million last year. We're net 3 million so far this year. So that is the capital structure. I guess one more thing I'll say, management and directors own about 6% of the equity. I talked earlier about the fact that we're really not in precious metals. What do we most closely approximate? When we're buying royalties, we're really looking to be in the biggest, deepest markets. And if that were to be compared against another, like a producer, it'd probably come closer to the diversified, so BHP, Rio, Anglo, than Barrick and Newmont compared to, say, Wheaton, Franco-Nevada. And not surprisingly, these big, deep markets end up aligning with global sustainability trends. So we're going to go into our revenue contribution. You'll see the breakdown, but just to talk a little bit about where our exposures are and what those ESG things are, the first one would be the energy transition. So we used to have as much as 30% of our revenue that was coming from Alberta coal royalties. And we got into that in 2014 in an acquisition that was of interest to us because it was part of a portfolio. So it was what was known as the Prairie Royalty Package, held by Sherritt, and comprised of potash royalties and thermal coal royalties. And thermal coal was pretty good business at the time. These had no commodity price exposure, they're purely tons. And given that the grid was coal powered, this was steady revenue business. Then in late 2015, the Alberta NDP government came in with provincial legislation to phase out coal, and the feds then came in on top of it. So royalties that were supposed to run till 2055 ended up being curtailed to 2030. You've seen other royalty companies diversify in energy. That's kind of a function of their success, really, in precious metals when they grow enough that the next opportunities are in deeper markets like the energy markets. So you got some of the precious metals royalties with oil and gas exposure. When we had this setback with the legislation, we absolutely looked at oil and gas exposure, but think about the timing. This is in 2015, 2016. The cost of renewables are just starting to crater. So the costs of solar have come down by 90%. That trajectory was really just starting. We could see, when I say we could see, it's our CEO could see, that these levelized costs of electricity were really going to overtake the cheapest electricity on the grid. And so we skipped oil and gas and went into renewables. And we'll talk later on about the genesis of that business and where it's going. Then electrification and storage, that's really our copper exposure, in addition to nickel, cobalt. Those are primarily Voisey's Bay. And we're also 12% owners in a private lithium royalty corporation. That's where our lithium exposure comes from. The agricultural segment, that's really our potash. We'll talk lots about that later on. And lower emission steelmaking is one of the industries that Bill Gates describes in his climate change book as hardest to fix. So manufacturing, including steel, ammonia, cement, accounts for as much as a third of GHG emissions and gets very little attention because all of the attention has really been on renewables. But Champion spent some time talking about EAF production and where the Labrador Trough fits in, and we're proud participants in that exposure through our 2.9 million shares of Labrador Iron Ore Royalty Corp and through our CAMI project, now out of receivership in the hands of Champion, and position and in a feasibility study. So this is showing you our 2020 royalty revenue broken down by contribution against our consensus NAV, so consensus from the 6 analysts who cover Altius Minerals. The 2020 royalty revenue was $67.5 million. The peak revenue was 2019. That's when it was 78. And we stopped giving guidance last year with the rest of the world during COVID. We haven't resumed giving revenue guidance because the commodity prices are really in such a dynamic phase. But what we have done is we've passed on the volume guidance from our operators. Volumes look similar or a little better than last year. And the analysts are expecting us to do between 74 and 79 million in sales this year. So another year could end up eclipsing the 2019 peak. If you look at the difference between the revenue pie chart there and the NAV pie chart, the big differences are copper going down and potash going up. And the reason for that is our copper exposure comes from two main assets, one being HUD-based 777 mine. 777, after a number of years of extension, is scheduled to close in mid-2022. The other asset is 3.7% stream on Lundine's Chapada, and that has a long life ahead of it. On the potash side, the increase there in NAV reflects the fact that potash mine lives can be up to 100 years, and the capacity utilization at the mines where we have royalties right now averages 66%. So over time, these assets are expected to continue their current annual growth rate. That's around 4% a year, and to grow into capacity as the operators really react to what we're seeing in the price trends. So just to turn quickly to the price trends, what we're showing on this slide is the change in the main commodities we're exposed to. So you can see them all on the bottom. It's just as a quick snapshot, our realized revenue in Q1 in each of these commodities was 20% to 50% lower. So I should say that another way. So the average realized price currently is 20 to 50% higher than what it was in Q1, or spot is 20 to 50% higher than average realized in Q1. So looking good for the quarter and the balance of the year. On the left, you're seeing the renewable energy chart. Renewables had a huge run up in the sort of fall to January timeline last year. January is when we did our IPO of ARR, and renewables have corrected 30% since then. We are not immune to that. We've seen a correction of just under 20%, and we'll speak to that a little later. And the venture is relevant because our project generation portfolio really kind of tracks the sentiment and the change in the venture market. So now we're going back to Altius's history, and we are the only diversified royalty player out there. I guess we're also going to be the only company in this conference that was started by a group of geology students at Memorial who started the company by acquiring land from the registry office. This is in the late 90s when they're in school, and doing some really limited early stage work, like I guess what you can do between classes, and then flipping those stakes on to companies for cash. So that basically paid tuition. And what turned into a business is in 97, they IPO'd. The company was $1 million at the time. And the business evolved into continuing to acquire land, do the early stage work, and instead of selling these projects for cash, they instead went to juniors, and we took back equity in the juniors and typically a royalty in the juniors. So the columns represent the number of projects on the bottom. Those are projects that basically got vended to juniors. We then took back equity. There's a lot of projects, a couple of them coincided with what was a real minerals rush in the early 2000s. So in the early 2000s, in 2003, Altius had done early stage work in the Michelin uranium project. They teamed up with Frontier and IPO'd a company called Aurora Energy in 2003. They also had done early stage work, ended up with shares in a company that became Rambler Mines. So the combination of the sales of Aurora when Paladin bought it at the 2009, the Rambler IPO, Virginia, that raised $200 million in cash profits. And the $200 million is really, for the most part, the company sat on it all through this period until 2014, when the markets had crashed again and there was an opportunity to buy the royalty portfolio from Sherritt. Then what you'll see is there's the last 5 years, pretty active period in the project generation portfolio. There's 18 positions now in equity juniors. Their mark to market was 54 million at the end of March. And there's been a steady flow of new companies created and launched where Altius owns more than 10% of Adventus, Origin, CanStar, Sterling, all of which are funded and active in exploration. So our portfolio companies in total raised roughly 150 million in the last year and announced drill programs that altogether add up to 200 kilometers. So how's this counter-cyclical philosophy apply to royalty purchase? You can see there's our very first royalty purchase in 2003. That's the royalty on Voisey's Bay. And in that period between 2003 and 2014, what's happening is the project generation positions are being sold for cash. We're being pitched on M&A constantly. We're saying no, prices are too high. And finally, in 2014, prices are low. We make our Prairie Royalties purchase for the coal and potash. In 2016, we buy the 3.7% Chapada stream. That really was the trough. Copper was $1.60 at that time. And it looks probably like we've been at a pretty steady pace doing a transaction or so a year since then. That's included buyouts of former joint venture partners. For you as investors looking at royalty companies, if there's one screen you can ask for, I think this is the screen to ask for, is show us what you paid in every paying royalty that you bought and what's been returned so far through the combination of, start with revenue. And what we've done in this chart is show you every royalty purchase, the revenue that's come back. Just one note on that is we're mainly royalties, one stream, which is the Chapada stream. So that Chapada stream has a 30% cost of sales, and that realized revenue takes off that 30% cost of sales. And then the net asset value column is giving you consensus estimates of what analysts think is the remaining value. So if we look at them one by one, Voisey's Bay already paid back, still got lots of life. The Chapada stream, good payback so far, still lots of life. The potash portfolio and the coal, you have to look at really together because they were purchased together. Coal, we're losing money on and we'll lose money on because of the energy transition. The operators won't even wait till 2030. They'll be out of coal as early as end of 2023. The IOC, that's our position in Labrador Iron Ore Royalty Corp, where we own 2.9 million shares. And ARR, that's our newest real deployment of growth capital. And you can see really what we invested. The slide says 180 million. It's actually, if I mark to market today, it's worth about 150 million. But that's really the track record of the company so far. And just for the sake of time, because I want to leave lots of time for questions, and I've got two companies to talk about. We'll end on minerals, and we're now into Altius Renewable Royalties. So, as I mentioned earlier, we launched the IPO in January, and it closed in March. There are 6 analysts covering Altius Renewable Royalties, or ARR. The cash that you see there, this cash is in US dollars. The cash is all the cash that was raised in the IPO. Altius Minerals continues to own 59%. That is a core hold, so you're not going to see much change in that percentage. And the share price performance, this is really showing what's happened in the renewable sector since the start of the year, and the Altius shares really reflecting what's going on in the renewable sector. There's a couple really important caveats here, which are renewables had a huge run up, which I mentioned earlier, in the latter half of last year, and they've had a big correction since then. One of the biggest threats to the renewables power producers is inflation. They're all highly levered. The difference here is key. So 1, there's no debt, and 2, inflation is good for us as a royalty holder because it increases the power price potentially, and our royalties are right at the top line, so they're on gross sales. And unlike the operator, we bear no share of inflating operating costs. So this is a timeline of really ARR being formed and where it is now. So back in kind of 2017, 2018, we were approached by a small group of renewable energy developers / portfolio managers out of New Hampshire. And Frank Getman was the CEO of a company, Great Bay Renewables. And Great Bay Renewables was essentially running the renewable energy portfolio for Tavistock Holdings. Tavistock Holdings was the energy arm of Joe Lewis, who's one of the UK billionaires. And Frank was an Altius shareholder. And he had seen enormous change in renewables since the sort of early 2000s. So he'd seen that whole change in the levelized cost of energy. And with all of that change taking place, he'd seen the adoption curve, all that change taking place. What's the one thing that didn't change? It's the way these projects are financed. So he talked to Brian Dalton, our CEO. They agreed, let's create the first renewable energy royalty company. There's a need for a new form of financing. There's got to be something that fits in between tax equity and project debt, where the project debt comes with all kinds of covenants, hedges, et cetera, and attempts to really quantify and button down an environment where it's impossible to control the risks that way. So that's really where it was born. And Altius acquired Frank's company, GBR, for $5 million. The first royalty investment they made was with a top renewables developer, Tri Global Energy. They then followed it with a $25 million with an even bigger developer, Apex Clean Energy. And then ARR went out looking for a strategic co-investor and ended up finding one in Apollo that basically was consummated in October of 2020. The JV requires Apollo to put in 80 million US to earn into a 50% interest. 80 million isn't Apollo's end goal. In their press release on the formation of that JV, they don't even mention 80 million. They talk about 200 million. That's more in keeping with their average ticket size. Then business really picked up from the time of that investment. So we're now 8 royalties. These are, you can see along the bottom who the counterparties are. They're diversified between wind and solar. They're all in the US. And this next map here kind of gives you a picture of that. So the royalties are basically 2.5% gross revenue or 3% gross revenue on wind, 1.5% on solar, and they're spread across the different renewables power regions in the US. These are all at the development stage. The first one to start production is expected to start this year, with most of the others coming online in between second half of 22 and into 2023. Actually, I'll just go back one slide here. There's a really important concept here, which is how do we achieve a rate of return in renewables that's commensurate with the kind of rate of return that we can get in our diversified royalties. So for those of you who follow renewables, you've been seeing IRRs that are in the sort of 3 to 5% as fundings become so much more competitive in the renewable space. And when we were doing the IPO, that was one of the top 5 questions, is just how do you even find an investment in renewables that'll get you a decent rate of return? So here's how we've done it. We've structured these deals with the portfolio, with the developers, so that our money, 55 million in the case of Tri Global, 25 million in case of Apex, when our money goes in, unlike debt, it goes in with essentially very few covenants and restrictions attached. The developers are free to use that money for development in anything that's in their portfolio. And we don't pick and choose which projects are going to make it. There'll be a spread of power prices between these markets as well. And sometimes it's as high as $10 a megawatt higher in the highest price versus the lowest price. But we don't have any say in that. The agreement we have is that as royalties, as projects get sold on to sponsors who are going to build and potentially operate those projects, a royalty gets assigned to us. And it has to be chronological. We don't have the ability to skip a project, and they don't have the ability to skip a project. So the key in controlling the risk is there enough projects in these developers' portfolios for us to be over collateralized? And as you can see, there's about 30 gigawatts in these combined development portfolios. We need about 4 to make ourselves whole, assuming a 10% rate of return as the midpoint. That's probably complicated, so happy to get any questions on it. And this slide is really just showing you, if we continue to invest at similar rates of return, then how ARR performs is just a function of how much capital can we put to work and how fast. And what this is showing you is what's been invested so far, the commitment of Apollo to put forward the next 80 million, the IPO proceeds that came in March. Apollo then has to match those IPO proceeds, and then we're funding on a 50-50 basis. So really about 195 million in liquidity to invest, and after that, we're funding on a 50-50 basis. How long does it take to put that money to work? Based on the projections we gave in the IPO, we said about 12 to 24 months to put that capital to work. And that concludes my presentation. So happy to have Mark come back and talk to us.
Wonderful, Flora. Thank you so much. I feel like we just went into 15 different wonderful directions about the sector and a complicated territory. I think you did a wonderful job helping us feel educated and informed. So I appreciate all the insight. And we do have quite a number of questions that have been filtering in. So my job here is to guide forward on. And I will remind our viewers to please let us know where you're from in the chat window. There's been some great back and forth. We're so curious to know where our viewers are joining in from. So please feel free to participate there. I'd love to start off, if I can, for around the fact that Altius Minerals is a diversified portfolio. Is there a benchmark commodity that most closely tracks your trading?
Yeah, that's a great question. And the most closely tracked would be copper. So copper represents our biggest revenue contributor. I think we're the only non-copper producer developer that's a member of the the US copper ETF, Global Copper. I think it's COPX is the symbol. That would be your closest.
Okay, thank you for that. It's great to have a guide there. I'm curious, with all the changes and challenges in the renewables in the last 6 months, and of course the Texas deep freeze that we're all aware of, how does your company grow exactly?
Yeah, well, the Texas deep freeze is a great example, because if you asked us back in the fall, when obviously that wasn't on the radar, we would never have said that there would be opportunities that flow out of a black swan event like that. But one of the real criteria for establishing this company was, is there a gap in the way projects are financed? And what happened in that Texas deep freeze event, I'm sure a lot of people know, basically 5 days of an unprecedented freeze event in Texas where grid power went up as high as $9,000, and the pipelines froze, so oil and gas power couldn't be delivered. Renewables had been built in Texas with no winterization, so there was no de-icing capacity. Renewables went down too. And in that event, there's something like 50 renewables projects that got affected by this requirement to buy power at these inflated prices to meet what's called shaped hedge offtake agreements that are part of the financing package. Interjects really publicized this well, because they went to court for a force majeure case that's still playing out in Texas. Actually, I think the first verdict was not favorable. But what this did was it really underscored the limitations of the kind of financing that existed for renewables. And these shape hedge offtake agreements required commitments of power that weren't even set on a monthly basis. So it wasn't like you had to deliver to the grid X numbers per month. It was every 15 minutes. So you had no way of avoiding that 5-day period. And now you got renewables operators of producing assets that are looking at, how do I get out of these hedge agreements? So they've come to us in some cases, and they're looking at opportunities where we could be part of a financing solution that enables them to take out wholly or in part those hedge agreements. So that's one opportunity. They're big ticket size too, that exists. But also there's the developer opportunity that we're already in. So the 2 developer partners we've got, that represents about 18% of the independent developer market. There's still lots of opportunities to go after other developers. And we kind of see ourselves continuing to execute on both those paths.
Okay, thank you for that. I mean, it's Mother Nature is one of those, you can never really count on something solid. It's always going to take us for a loop. So great to hear your perspective on that. I'm curious to know, in terms of inflation, how much of a threat is that to your renewables?
Yeah, I mean, I think that is a net positive, because one of the other factors about how renewables have been financed is that every project, when it's sold on to a sponsor, has a PPA, so a power purchase agreement, that locks in the price. And initially, those PPAs used to go for 20-year terms. So you'd be looking at 20 years worth of locked in prices, and electricity prices are at a trough. So these PPAs could lock in very low prices for a very long time. What's happening is in the PPA agreements in the last year is that those terms are gradually getting shorter. So from 20 years to 15 years, now they're down. Some of them are down to 12 years. Some of them are not for 100% of the power. They're only for, say, 70% of the power. And one thing with inflation is that it's likely the end or close to the end of these historically low power purchase prices. Okay. And that's good for us because our royalty is 3% of the output times the price, whether it's locked in or spot.
I see. Okay. Great, thank you for that. Jacques asked a question here. Nutrien and Mosaic have been recent developments regarding production capacity changes. What are the likely implications in 21-22 potash royalty revenue?
Yeah, it's a good question. So for 2021 and 2022, I guess, Jacques, what you're referring to is Nutrien's announcement on the 500,000 ton increase overall. I think that's a pretty modest increment in terms of their overall annual output, but it sounds like they announced it in order to up their guidance, which they've said is coming. So I think we haven't yet narrowed it down to a new forecast for 2021, 2022, but it's all driven by, you're seeing crop prices, 8-year highs, Midwest corn, 10-year high, soybean oil, and fertilizer prices just starting to follow suit. And that's incentivizing decisions at the producer level that require a lot of lead time to develop new capacity. Mosaic, I think you're referring to Esterhazy, where you've got lower production, but that 1 million tons they're talking about, again, when you look at our unitization, ownership, et cetera, that looks like it won't have any kind of significant negative impact.
Okay, great to know that. Thank you for that. A great question here from Justin, who says, where do you see future growth coming from? Is there a strong focus in one direction or another?
Yeah, so I guess one of the wild cards is really the Kami royalty. And to be honest, I don't know if Champion talked about this at all, because that's when I was in the backstage area here.
Yeah, certainly Kami was covered in a couple of directions, yeah.
But I guess, so Kami, in terms of its annual revenue projections based on current iron ore spot, and I know Champion had a lot to say about current spot at that 65% Fe level and how much higher that is than consensus. But 1 year's worth of Kami is better than our peak revenue in 2019. So that's obviously a big game changer, and it comes with a lot of caveats. There hasn't even been a feasibility study. No one's modeling it. So take that aside. If we look at the potash and just the growth in supply, it's been growing at about, our royalty percentages and our exposures have been growing at about 4% compound annual in the last 7 years. So that just basically takes Saskatchewan market share. We do a little better than that because of the way we've been able to purchase exposure to unitization areas.
Yes.
So we grow into both higher volumes on potash and what seems like higher prices.
Yes.
We got Kami on the iron ore side. We got a new copper royalty, Excelsior. and we got great conditions in project generation.
Okay. Yeah, it's always interesting to hear the thought process behind the scenes. So I appreciate that. I just want to be mindful of our time too. At this point, we're going to start to wind down. We have one session left today, but Flora, thank you for bringing all you have to the event today. I know that our viewers are very grateful, and I think we had some great questions come up as well. So we look forward to hearing from you more down the road and seeing how the organization performs. Thank you for your time.